Tyler, a 75 basis point increase by the Federal Reserve, bringing the target range for the Fed's benchmark interest rate to 3.75% to 4%. The decision for a fourth consecutive 75 basis point increase was unanimous, but the statement does add a new flexibility on the pace of future rate increases.
They adjusted the pledge that the committee anticipates ongoing increases in the target range will be appropriate, adding, in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
It's out, and it's not good news. The Fed has just announced it's adding another 75 basis points to the federal interest rates, bringing the Fed interest rate range to 3.75% to 4.7%. It's expected that the range could reach as high as 5% by mid-2023, and there's no pivot in sight. Peter Schiff, economic analyst and commentator, had earlier hinted that we should not expect an easing anytime soon. So what are his predictions? Let's listen to his warning. Our data shows that only 8% of our viewers are subscribed to the channel. What are you waiting for? Click that subscribe button now.
But if interest rates stay where they are or continue to move higher, which is the most likely path, at least given what the Fed has been saying thus far, and given the inflation numbers that we have, then we have a long way to fall to get back to normal. But there is no reason why the market should be priced at a normal valuation, given the adverse circumstances that are now taking place. We have the highest inflation in 40 years, maybe the highest inflation ever. The Fed has a monumental task in front of it if it's actually going to deliver on its promise to bringing inflation down to 2%. So if you believe the Fed that they are every bit as resolute in their commitment to bring inflation back down to 2%, and they're going to do whatever it takes to achieve that goal, then you have to concede that the market is not going to fall to a normal valuation, but a below normal valuation. In other words, we should have a price to earnings ratio below the norm. We should have a price to sales ratio below the average, because obviously these averages mean that at times since 1995, the PE was lower than average, or the price to sale was lower than average. Why? Because during those periods of time, the markets were under adverse circumstances. Well, I can't think of more adverse circumstances than the ones that the market is operating under right now. And so if during times in that time period, we had a market that was cheap relative to its historic averages, we should have a market getting cheap again relative to its historic averages. But not only is the market not cheap, not only is it not averagely or fairly valued, but it is still extremely expensive. So we have a market priced for perfection, and we have anything but perfection in the current circumstances. And so what this is telling me is that investors still don't believe the Fed.
Jerome Powell, head of the U.S. Federal Reserve, has made it clear in his last address that it is too early to pause raising rates. Current rate now stands at 3.75 to 4%, as against 3% to 3.25% it was previously. The previous target was an average of 4.6%, but Powell suggests that as it is now, the interest rate could well go over this target before they can get inflation where they want it. This would be the fourth consecutive rate hike this year, and all has been by 75 basis points, though there are suggestions that this rate of increase would slow down in the future. The rate hike has come as no surprise, as most financial experts had anticipated it. Some analysts, such as Peter Schiff, had even accurately called the 75 basis point increase. Oddly, the market reaction was positive to the announcement. It seems the investors had braced for a hike, and they had prepared to embrace it. This rally would be short-lived because upon Powell's revelation of the Fed's commitment to get inflation down to 2%, the stock market dipped. The reason for this decline is most likely because investors expected the Fed would soon pivot, probably after this latest hike. But Powell's speech was not assuring enough. It seems we still have a long way to go. The hiked rates would affect investors and consumers in several ways. The effect would trickle down and only get worse as it gets to the lower echelon. Interest rates from the Fed may stand at 4%, but it would be more greatly felt at the credit card level because the rates would have massively compounded before getting to the borrowers at the household level. This would affect not only people borrowing to spend, but those who need credit for businesses. There is now an increased sentiment that the economy would indeed enter a recession within the next 12 months. According to models and analytics by Bloomberg, there's a 100% probability the economy would be in a recession by October 2023. Peter Schiff says as long as the Fed is committed to getting inflation down to 2%, we must expect a below-average price valuation in the assets market.
They believe that the Fed will be able to quickly bring inflation down to 2%, and after it does that, it's going to be able to return interest rates back to their artificially low levels. We're going to go back to zero or near zero, and we're going to go back to quantitative easing, because without 0% interest rates in QE, there is no way to justify the current valuation of today's market. But if investors believe that, they are wrong. First of all, they're wrong if they believe that the Fed is actually going to bring inflation back down to 2%, because it's not going to get anywhere near 2%. But they're also wrong to think that even if the Fed succeeded in bringing inflation back down to 2%, that we could have a return to those abnormally low interest rates and inflation would stay at 2% or lower. Neither of those outcomes are possible. The only way the market could be correct in attributing these high valuations to today's market is if I'm right about what happens, that the Fed pivots and gives up the fight against inflation, even though inflation never returns to 2%. In fact, inflation gets higher than the 8 3/4, which I think was the high so far on the CPI. So inflation is going to break out to new highs, yet the Fed is going to give up that fight and is going to go back to monetary stimulus, even though inflation is getting worse.
Peter Schiff is not alone in predicting a grim future. Many experts believe that the Fed's fight against inflation is futile. This claim seems to be supported by how slowly the inflation rate is shrinking, despite very aggressive rate hikes. In June, the inflation rate had peaked at 9.2%, the highest it has been in the past 41 years. Yet after massive hikes the U.S. has not witnessed in the past 41 years, inflation still stands at 8.2% since the last report. Mr. Schiff is convinced that the Fed cannot meet their 2% target. He believes that even if inflation comes down now, it would only be temporary, before it goes back to over 8%.
Inflation is going to drive the price of everything up, including stocks. But if I'm right about that happening, then what you're going to see is the gains in the stocks like those that are in the Dow Jones, and you're not going to see the gains in the NASDAQ type stocks. That rotation and that divergence in performance is going to accelerate in the environment that I see coming, where we have the Fed conceding the fight against inflation. So inflation wins and the Fed loses. And so investors are looking for real hedges. They want to get out of paper into real assets, which would include ownership of real businesses. But that would be ownership of businesses with real assets, tangible assets that are selling products that people have to buy, not products that people want to buy and that they only buy with the money they have left over after they finish buying all the stuff they have to buy. So it's going to be back to basics, bricks and mortar, and it's going to be buying value, selling growth.
As far as Peter Schiff is concerned, inflation has come to stay, and people have to adjust to it by investing in brick-and-mortar businesses that meet the demands of society and not risky growth stocks. If you enjoyed this video, then clicking the like button would be great. Don't forget to subscribe for more. You don't want to miss out as the market gets more risky.